evening and welcome to this week's session of the Home Buyer Bootcamp brought to you by People Driven Credit Union. These seminars are dedicated to helping new homeowners make informed and confident decisions throughout the home buying process. Tonight's agenda includes an explanation of loan options, interest rates and how they work, closing costs, and the final steps to get you to the closing table. As far as loan options, we're going to discuss the fixed rate mortgage, adjustable rate mortgages, and then we're going to take a look at down payment requirements and wrap up with what works best for you. So the fixed rate mortgage. The fixed rate mortgage is probably one of the most commonly used programs by borrowers today, and that is because the interest rate remains the same throughout the entire life of the loan. And basically what that means to you is that you have payment stability, making it an easy budget item. With the fixed rate mortgage, you will take your loan and spread it out or amortize it over a certain number of years. And that can be 30 years, 20 years, 15, or 10. And when you amortize your payment, the payment that you make will be broken down into different buckets. The payment will include principal and interest, and possibly taxes, insurance, and association dues if you happen to be buying a condominium. With a fixed rate mortgage, the principal and interest payment portion will never change. And that is the piece of the payment that goes to reducing your outstanding loan balance, as well as pay the lender the interest for the money that you are borrowing. Because that part of the payment can never change, it makes it a favorable option for many buyers. Adjustable rate mortgages. So these are often referred to as ARMs for short, and these are mortgages with a variable interest rate feature. One of the benefits and biggest benefits of these programs is they typically offer initial lower interest rates and therefore a lower monthly payment that you can enjoy. The payment itself is spread out over 30 years, and that is the amortization piece. If you're considering an adjustable rate mortgage as one of the options, it's really critical for you to understand how they work. So we're going to talk about how the interest rate is derived for these programs and what makes up the interest rate. With an ARM, there are two key components. One is the index and one is the margin. So what are these pieces? Well, the index is a financial instrument or benchmark that is tied to the market and used to calculate your interest rate. This is the piece or the component of your rate that has the ability to adjust over time and will adjust based on what the current market conditions are. The margin is a fixed percentage rate that is set by your lender and added to the index to create your interest rate. When you're looking at ARMs, again, it's important to understand all the features to them. So there's frequencies built in, and I'd like to take a few minutes here to explain them to you. On my screen, I have a few different examples, and these are naming conventions that you might run into. And there are many, many different types of programs out there, so their conventions or their namings might be a little bit different. But here on my screen, I have what we call a 10-10 ARM, a 7-1 ARM, and a 5-6 ARM. So those numbers do have meaning, and I'd like to break those down just a little bit here for you for understanding. So the first number is the initial term period, and this is the period in which your interest rate is fixed and will not change. The second number represents the frequency of future adjustments, and this can be in years or months. So when you're considering an adjustable rate mortgage, it is important for you to understand the program that you're looking at. To break it down a little bit further, here I'm going to use the 7-1 ARM as an option. So these numbers tell me that for the first 7 years, my interest rate would be locked in and would not change. In this example, the 1 represents a frequency of 1 year. So this means to me that my interest rate has the potential to change starting in year 8 and every year thereafter. Now, again, remember, I mentioned that the second number represents the frequency, and that could be in years or months. So you want to make sure when you're considering an ARM, you understand when that could adjust. One piece that I haven't mentioned yet that I do want to talk about is because the interest rate is variable and it's tied to the current market and the index that is selected, it does have the ability to move up or down based on current market conditions at the time of your adjustment period. Now, with these loans, they do have some protections built in, and they're referred to as rate caps. So here in my example, I am showing a 225. So what does this mean to you? The first two represents the initial change cap. So that's the maximum percentage that my interest rate can change at the very first interval. The second number represents subsequent adjustment caps. So this again would be the maximum percentage that my rate could adjust after that initial adjustment period. The last number here represents the maximum percentage that my rate can adjust. So we have 5. So what this means to you, and I'm going to tie it back to this 7-1 arm so it makes sense. So if I have a 7-1 arm, again, my interest rate could change in year 8 because that is the first adjustment period. The maximum it could change would be 2%. In year 9, it will adjust again. And again, I also have a cap of 2%. In year 10 and 11, they could change again based on current market rates. But I have the protection of knowing that the maximum my interest rate will ever change would be 5%. Now, these protection caps will vary in this frequency. These numbers are just an example here in tonight's presentation, but they will vary by product and lender. Again, it's important for you to understand the frequency of how ARMs work so you know exactly how the program will behave and how the interest rates could move for you in the future. Now, ARMs are good for a lot of different people who are looking to enjoy those lower interest rates and the smaller monthly payments. Example of who this might benefit is someone who maybe is looking at buying a home, but they know that they're maybe not going to be there for a long period of time. So maybe you have the type of job that your employer does relocate you, I don't know, every 5, 6, 7 years. An ARM option would be a great program to consider because you can take advantage of those lower interest rates and the lower payments while you're in the home. Now, there could be other reasons and other examples why ARMs might work well for you. And I've recently worked with a set of borrowers who were looking to purchase a specific home in a specific city because they had children entering into high school. And they wanted their children to go to a particular school within the school district. And their home and the location was limited to those 4 years. They didn't really want to be there long term. It was just for that specific reason to get their kids through school. So this was a great option. They could take advantage of the lower rates and lower payments. Now, one of the nice features about an ARM as well, outside of the interest rate, is the loan can recast with no formal application or approval process. What does that mean to you? So recasting basically means re-amortizing the outstanding loan balance against the remaining years. So for example, maybe I'm a borrower and I receive bonuses or commissions, and from time to time, I may have the ability to drop a lump sum payment down on the outstanding principal balance of my loan. What's nice about that and with an ARM is when your ARM enters into the adjustment period, it will re-amortize. So it'll re-amortize with the new interest rate and the outstanding loan balance. Therefore, if you happen to have the type of income that will allow you to put down a large down payment from time to time, or if you know that you're selling perhaps another home or another piece of property or asset that would allow you to put like a substantial payment onto your outstanding balance, you can enjoy those benefits of a lower payment. Okay, so let's talk a little bit about down payments. So down payment requirements are going to be based on the type of program that you select. And they can range by program anywhere from as little as 3% in most programs and up to 20%. So that is your down payment or your contribution, and the percentage is based on the purchase price of the home. So for example, let's say I'm looking at purchasing a home that the purchase price is 250,000, and I'm looking at a mortgage program that requires me to put down 3%. The amount of my down payment would equate to $7,500. Now, often we get questions of how do we make that down payment and how does that piece work? How and when does that payment occur? And there's a couple different options here. So basically what happens is when you're working with your realtor and you go to make an offer on a home to the seller, along with the contract, you're often providing what's called earnest money or good faith money. And that amount can vary. Your realtor is going to guide you on what that amount should be. But let's say in my example, my realtor and I agree that maybe that is $2,500. So bringing that back to my $7,500 down payment, I may give that $2,500 upfront, and I would get credit for that at the closing table going towards my down payment. Now, as far as down payments and where those funds can come from, there's a variety of different options. You may have them saved in a retirement vehicle, perhaps your checking savings account or a money market account, or perhaps you even have a family member that's willing to give you a gift. Those are all viable options for obtaining and making your down payment. Now, what works best for you? Well, that's different for everybody, and you really need to consider your overall financial picture. You want to take a look at things like your job and the stability of it, as well as your family dynamics. Maybe your family is comprised of two people today, but in the foreseeable future, you plan on growing your family, maybe having a couple of children. So you want to take all of those things into consideration along with your financial picture, because those will help guide you towards the best programs. In my opinion, if you are seriously looking at buying a home, the very first place you should start is with your mortgage professional. Reach out to your people-driven credit union mortgage consultant to talk about your finances and your long and short-term goals. So interest rates and how they work. We're going to talk a little bit about how rates are determined and then the things that you can do and what affects your interest rates when you're looking at applying for a mortgage, and then how to get the best deal. So how are interest rates determined? Well, I already went into that with a little bit with the ARM. Again, that your rate on an adjustable rate mortgage is the index plus the margin. Now, for 30-year options or 20 years, so those fixed rate loans, those are tied to the 10-year Treasury note. So if you're looking and monitoring interest rates, that's the investment vehicle that you want to watch, because as the Treasury rate goes up and down, mortgage rates usually will do the same. Now, the mortgage rate will also include a little bit extra to cover the costs and risks associated for lenders. So what impacts your rate? We kind of talked about how rates are derived and the investment vehicles they're tied to. But as borrowers, we can impact our rate and what we qualify for. And one of the biggest pieces of that is credit. The lender is going to take a look at your current credit situation, looking at the credit score, your current obligations, and then how you've managed credit in the past. So they're going to look at the history. That piece is very critical in determining the interest rate that you qualify for. The best suggestion that I can give to you is make sure you're not overusing credit. So use it when it's needed and ensure that you're making all payments on time. Those will help you to create a healthy credit score. Now, down payment. Down payment is a component of the interest rate. The more you put down, generally the more favorable rate that you will get. And again, the terms and the product selection for the mortgage will also have an impact on rate. The rates do vary. So for example, a 30-year fixed mortgage rate is potentially going to be a higher interest rate than your adjustable rate mortgage. So all these pieces do go into the financial picture of creating your rate and determining what you qualify for. Again, the very first step you should do is to work with a mortgage professional who can sit down with you, go over your finances, and talk to you about what you qualify for now. And maybe you're not mortgage ready today, but that is the first step in seeing exactly what you qualify for, and you can work together to get ready in the future if it happens to be not right now. So, how to get the best deal? I always encourage you to start with preparation, and you can do a lot of research on your own. There is so much information out there available, and it will give you the basis of the process and what you can do to get ready. It will also help you determine some of the questions that you may want to ask your mortgage consultant when you do have that conversation and start talking about the different programs. Again, you make sure that you want to pick a good mortgage professional from People Driven Credit Union to help you with that process because they're going to match you up with the best programs to meet your short and long-term financial goals. Finally, once you identify the property and talk about the programs that you want to apply for, you can lock in your interest rate. When you do lock in your interest rate, it will protect you from fluctuations. Okay, so let's talk a little bit about closing costs and the final steps to get you to the closing table. So closing costs are made up of different components, and closing costs really equal your loan costs plus other costs. So what does that mean to you? So loan costs are the costs that are associated with the mortgage that typically the lender charges to obtain the loan. These costs can range from anywhere from 2 to 5% of the loan amount. And these costs include things like the appraisal fee. An appraisal is the instrument that is used to assess the value of the property and determine that value. Title insurance fees, those are typical in mortgage transactions, and those help protect you to ensure proper title transfer from the seller to you as the new homeowner. There could be attorney fees as well as loan origination costs. And most of these, they work together to create your overall closing costs. But there are a few other costs that you should be aware of. And they're not charged necessarily by the lender as a fee to obtain the loan, but there are other costs associated with obtaining a mortgage. And these can include your homeowner's insurance, so that first year's premium is due at the time of closing. If you set up that escrow account to pay for property taxes, insurance in the future, then establishing that escrow account at the time of closing does have a pre-funding that needs to be taken care of. So again, closing costs will equal your loan costs and your other costs. Now that breaks down to what we call cash to close. And this is not literally cash that you're bringing to closing. It is, you are going to make that payment at the time of closing, but it's not in the form of literal cash. And that's more the term that we use in the mortgage industry. That cash to close is going to be your total closing costs as well as your down payment. What that looks like, you're going to get a disclosure. It's called a closing disclosure, and you'll get it as you start to near the end of the mortgage process. And that closing disclosure is going to be a detailed document that outlines the final figures of your loan and letting you know exactly what you need to bring to closing. Some do's and don'ts. So during the mortgage cycle, so from the time that you start to move forward with the contract and the seller, there's a couple things that you want to be mindful of. Probably one of the most important things that you want to do is to continue to pay all of your credit obligations on time and try not to make any late payments. You also want to continue to save. So probably by now you have some healthy savings habits. So you want to continue with those so that you have enough funds to get to the closing table. A couple of items that you want to be mindful of and try not to do is to quit your job or change jobs. Because throughout the mortgage process, when the lender takes a look at your financial situation, your income stream is a critical component. So if you quit your job or change jobs in the middle of the process, it could impact your eligibility for the loan. Also, try not to obtain new debt. So try not to go out and buy a new car or any, large ticket items that would change your overall financial picture. As well as don't be late on payments. We already kind of talked about that. Now, when I'm talking about these don'ts and things that you want to try to avoid throughout the mortgage process, I'm not saying don't live your life. If something happens and you have one of these, what we'll call major events that you know is going to occur, I would encourage you to reach out to your mortgage consultant as soon as you know that a change is going to happen. That way, they can guide you on what might be the best solution and then let you know how, if at all, it impacts your eligibility for the loan. Preparing for closing day. It's always an exciting time getting to that closing table. There's a couple of things that you want to do. And one is review that closing disclosure I mentioned in advance. At a bare minimum, we are going to send you a closing disclosure at least 3 days in advance for you to review. And again, this is going to be a document that details all of the transaction items. It's also going to remind you of what your principal, interest, taxes, and insurance payment is going to be, and then all the costs associated with the loan and break down your down payment requirement. So it's going to have that final number, again, that cash to close that you need to bring to the closing table. Where is the closing table, you might be asking? That generally happens at the title or attorney office that you select throughout the process. And you will meet there with potentially with your lender and your realtor on closing day. Now, how to get those final closing numbers and that cash to close to the closing table? A few days before closing, you're going to go to your local credit union and you're going to obtain either an official check, which is also called a cashier's check, or you're going to initiate a wire. Your mortgage consultant is going to guide you on what the requirement of that is, because it can be different in each transaction. Some may allow the cashier's check and some may want a wire. Now, when it comes to the closing itself, we make closing easy. We make it very simple for you to go through the process through our hybrid e-closing. What this is making the ability for you to do a lot of the closing in the comfort of your own home, either from your PC, tablet, or smartphone. So what we're going to do is send you the documents in advance, generally a day or two before closing, and you will have the opportunity to review each document thoroughly and take a look at it. Now, the day of closing, that's where you'll go back in to look at your documents and actually sign them. Because when they're sent to you in advance, they're sent with a predetermined date. So you cannot sign them in advance. So if we send them to you 2 days before for your review, they will become available for you to sign on the actual closing day. So you'll wake up in the morning, go through your documents again, and apply your electronic signature. You're still going to show up to closing. Again, you're going to meet with your realtor and your lending agent and sit at the closing table with the title company and sign just a very few number of documents. And these would be documents that would require what we call a wet signature, so your physical signature, because they need to be in front of somebody that has notary capabilities. But what's nice about the hybrid e-closing is it is very simple and convenient for you. And now that you've reached the closing, you can go ahead and get your keys to your new home from your realtor and drive right on over. I would like to thank you today for sharing your time with us this evening, and I've hoped you've learned some new helpful information that will assist you during your home buying journey. Thank you again, and have the best night.